Hello friends, welcome to my YouTube channel Income Tax with CA Aditya. This being the first video, I would just like to give a brief introduction as well as background about myself and what I intend to do with this particular channel of mine. I am Aditya Ramchandran, a chartered accountant by profession. I have been practicing for the last 7 years in this particular field. My main area of practice is income tax litigation and that too domestic taxation. By virtue of this channel, I would be posting regular videos on insights and updates on direct taxes, as well as decisions of courts and tribunals, which would help all the professionals in this field, as well as budding chartered accountants, and of course, the general masses. In this video, I will be discussing the major changes as far as long term capital gain taxation is concerned, and this particular change has been brought in by the amendments by Finance Act 2024. Finance Act 2024 had made some major changes as far as this long term capital gain taxation is concerned. In order to summarize what these changes were, there was a change in the definition of how do you define a long term and a short term capital asset. There was a change with respect to the rates of taxes for taxing long term capital gains. So, for transfers which were made prior to 23rd of July 2024, the old rates were being followed. And for transfers on or after 23rd July 2024, the new set of rates have been given which has to be applied. Another change was there was a benefit of indexation which was available. Now, this benefit of indexation has been done away with for transfers which have been done on or after 23rd of July 2024. Now, what is the effect of doing away with this benefit of indexation? This benefit of indexation which has been done away with has a very major impact as far as your applicability of surcharge is concerned, as well as the exemptions which you claim under section 54 or 54F, so on and so forth, as well as the impact on rebate under section 87A. So in this video, I will be discussing these impacts which have been listed over here, as a result of which your indexation benefit has been done away with. Now, before we understand the amendment as far as doing away with the benefit of indexation is concerned, let us first understand what is indexation. So, in simple terms, indexation is nothing but an adjustment to the cost of your asset or cost of improvement of your asset in order to factor in the effect of inflation. So, just to clarify in the beginning itself, the benefit of indexation is available only to a long term capital asset. In order to explain this better, we can have an example. Consider an asset which you have purchased in the year 2000, say for rupees 5 lakh of rupees. Now today you intend to sell this asset. So but naturally on account of market conditions, the value of asset will increase. So today the selling price would be 20 lakhs. So when you sell this asset for 20 lakhs, this being a capital asset, you will have to compute long term capital gains. So, how do you compute long term capital gain? It is very simple. The selling price of 20 lakhs will be reduced by the cost of 5 lakh of rupees. So, your long term capital gain comes to 15 lakhs. But over here, since this is a long term capital asset, the Income Tax Act was providing a benefit of indexation. Like we can see that the asset which was purchased for 5 lakhs is now being sold at 20 lakhs. The Income Tax Act says that you apply indexation to the cost of acquisition. So there is a cost inflation index which has been given, and by applying that cost inflation index, suppose for say example, in our scenario, the purchase price gets increased from 5 lakhs to 12 lakhs. So that 12 lakh of rupees is nothing but the indexed cost of acquisition. So after applying the indexation which has been given by the income tax department, my 5 lakhs of cost is now standing at 12 lakhs. So if I now compute my long term capital gain, my long term capital gain is 20 lakhs of selling price as reduced by the 12 lakhs of indexed cost of acquisition. So my long term capital gain is now at 8 lakh of rupees. So as we can see, without indexation, my long term capital gain was 15 lakhs. Whereas after applying indexation, my long term capital gain is now standing out 8 lakh of rupees. So this is what indexation benefit is. Now, under the Income Tax Act, Section 48, this particular section provides the manner of computing the income under long term capital gain. Now, there was an amendment to Section 48. Section 48 of the Act was amended to say that the indexation benefit, which we just discussed, will not be available for transfers on or after 23rd of July 2024. So, but naturally, if you have transferred a long term capital asset prior to 23rd July 2024, the indexation benefit was still applicable. But now, if you transfer a long term capital asset after 23rd July 2024, indexation benefit will no longer be applicable. So, that is the first amendment which I have discussed with you. The second amendment is with respect to Section 112. Section 112 provides for taxing long-term capital gains, but it is restricted to certain classes of assets and it excludes equity shares on which STT has been paid, equity oriented funds, and units of a business trust. So I won't be dealing with these classes of assets. Now, what is the amendment to Section 112? So Section 112 was amended to provide that there was a change in the rate of taxing long-term capital assets. So if you have transferred a long-term capital asset prior to 23rd of July 2024, the rate of tax which was applicable was 20%. But if you have transferred the long-term capital asset after 23rd of July 2024, you are now liable to pay tax at 12.5%. Now, if we just connect the amendment with respect to the indexation which we just discussed and this particular amendment, the cutoff date is same, 23rd of July 2024. So if you transfer a long-term capital asset after 23rd July 2024, point number one is you don't get the benefit of indexation, and now you are liable to pay tax at 12.5%. Now, as far as this benefit of indexation which has been done away with, so we might think that okay, this is a disadvantage to us. For that particular purpose, there is a relaxation which has been given, and this relaxation is also by virtue of this amendment by 2024. What is this relaxation? There are certain conditions which have to be satisfied. In order to avail this benefit or relaxation, it can be availed only by an individual or HUF. And the long term capital asset which you are selling should be either a land, building, or both. So, for simple terms, a residential house will qualify as a land or building or both. And the third condition is that the land or building should have been acquired before 23rd of July 2024. These are the three conditions you need to satisfy in order to claim or in order to avail the relaxation. Now, once you satisfy these conditions, what is the relaxation which is given? So, the tax or the excess tax which is calculated after applying indexation as compared to the tax without applying indexation, that would be ignored. So this particular thing can be explained with the help of an example. Suppose for say my selling price is 20 lakhs. I have sold a capital asset, the selling price is 20 lakhs. I have purchased it for 5 lakh of rupees. So the indexed cost of acquisition in my example which I had given earlier was 12 lakhs. So I have to now compute the capital gain in two parts. First, I have to compute capital gain and tax thereon without applying indexation. And in the second part, I will have to compute the capital gain after applying indexation and the corresponding tax on that. So let us first compute the capital gain without indexation. So the capital gain without indexation comes to 15 lakhs. That is very simple. It is 20 lakhs minus 5 lakhs. Now tax at 12.5 percentage on this capital gain of 15 lakhs comes to 1,87,500. The second step, I have to compute the long-term capital gain after applying indexation. So my index cost of acquisition was 12 lakhs. So if I reduce my selling price of 20 lakhs by 12 lakhs of rupees, I arrive at 8 lakhs. So 8 lakhs is the capital gain after applying indexation. Tax at 20% on that indexed value of capital gain would be 1 lakh 60,000. So now I have to calculate what is the excess tax what I have to ignore. So the excess tax that I will be ignoring is 27,500. How do I arrive at 27,500? That is nothing but the tax without applying indexation, and from that amount I have to reduce the tax after applying indexation. So 1 lakh 87 minus 160, that is the amount which I will ignore when I finalize my amount of tax which I have to pay on capital gain. So what is the final amount that I will be paying? That is 1 lakh 60, and this amount has been arrived at by 1 lakh 87 500, which is the tax of without applying indexation, and by reducing that excess amount of 27 500. So ultimately what is happening is I am paying tax on the figure after applying indexation indirectly. Now this relaxation or amendment which we just discussed, it is not a case where my manner of computing total income is determined. This amendment is with respect to the manner of computing tax on my long term capital gain. So there is a difference between the two. Manner of computing income is different, and manner of computing tax on income, both are different. Now what we discussed is manner of computing tax on my income. Now that income was long term capital gain. Now, in order to explain this differentiation, I will be dealing with certain examples. Suppose I am a salaried individual earning a salary of 48 lakh 50,000, and in addition to that, during the year I have sold a long-term capital asset, and therefore I have income from long-term capital gain. So now I have to compute the tax on the salary as well as I have to compute tax on long-term capital gain. As far as computing tax on salary is concerned, the answer is very simple. I have to apply the slab rates, and I have applied the slab rates as per the new tax regime. So the amount comes to 11 lakh 45,000. Now, as far as computing the tax on long-term capital gain, I have sold this capital asset for 5 lakhs and I had purchased in the year 2000 for 1 lakh. So correspondingly, the indexed cost of acquisition after applying the cost inflation index comes to 3 lakh 63,000. So as we had discussed earlier, now I have to compute the tax in two parts when I have to arrive at the tax on long-term capital gain. The first part, I will compute the tax without applying indexation. So what is the amount of tax without applying indexation? It is 50,000. How do I arrive at 50,000? It is the selling price of 5 lakhs and I reduce it by 1 lakh of cost of acquisition. So the answer is 4 lakhs, and on this 4 lakhs I will apply 12.5 percentage. So the amount is 50,000. The second step, I will compute the tax with indexation. So 5 lakhs of selling price will be further reduced by 3 lakh 63,000 of cost of acquisition after applying indexation. So it would be 1 lakh 37,000, and on this 1 lakh 37,000 I will apply 20 percentage. So the tax with indexation comes to 27,400. The next step is to calculate what is that excess amount of tax which I need to ignore. So that excess amount of tax which I need to ignore is 22,600. How do I arrive at 22,600? It is 50,000 of tax without indexation, and I will reduce 27,400 of tax after applying indexation. So the net amount comes to 22,600. So this 22,600 is the amount which I have to ignore while I compute the final amount of tax on long-term capital gain. So I arrive at the final amount of long-term capital gain tax at 27,400, which is nothing but 50,000 without indexation reduced by 22,600, which is the amount which I have to ignore. So the amount comes to 27,400. So once again, indirectly, I am paying tax on the amount of capital gain after applying indexation. Now let us compute my total income in this particular scenario. So total income is nothing but I club all the income under different heads, say income from salaries, income from capital gain, income from business, income from other sources or house property. So after clubbing all the income under all the heads of income, I arrive at the total income. So in my case, there are two heads of income. One is income from salaries and the other one is income from long-term capital gain. So income from salaries, the amount is 48 lakh 50,000. That's very simple. Now, when I compute the income from long term capital gain, what would be the income from long term capital gain? Some might say that the amount is 1,37,000. How did I arrive at that 1,37,000? Because indirectly I had paid tax on capital gain after applying indexation. So ideally, I have paid tax on 5 lakhs minus 3 lakh 63,000 of indexed cost of acquisition. So the amount comes to 1 lakh 37,000. So many might think that the income from long term capital gain is nothing but that amount of long term capital gain on which I have paid taxes. But that is incorrect. In this particular case, the income from long term capital gain would be 4 lakhs, which is 5 lakhs minus 1 lakh of cost of acquisition. And why do I say so? If you recollect, I had mentioned earlier that the benefit or the relaxation which has been given is with respect to the manner of computing the tax, and it is not with respect to computing the income under the head capital gain. So my income under the head capital gain remains the same, which is 4 lakhs. That relaxation or benefit is with respect to only the computing tax on long term capital gain. So by applying this particular concept, my total income is now at 52 lakh 50,000. And since my income is now exceeding 50 lakhs, I am liable to pay a surcharge of 10 percentage. So this is a very important concept which we all need to understand. Now this particular thing has a further bearing on how do I apply the exemption provisions. So under the Income Tax Act, there are sections, section 54, 54F and 54 EC, which provide for certain exemption, which say that if I have sold a residential house or a land or building, and if I invest into another residential house or if I purchase bonds, I will be given an exemption. Now, for a person to determine that if I want to claim an exemption and if I want to save taxes on my long term capital gain, he has to determine what is the amount which he has to invest. Now, considering our same example, that my salary income was 48 lakh 50,000. I have sold a capital asset of 5 lakh of at 5 lakh of rupees. The purchase price was 1 lakh and the index cost of acquisition was 3 lakh 63,000. Now, in order to compute that what is the amount of investment which I have to made in order to save taxes on long term capital gain. So I compute the tax without indexation at 50,000 and tax with indexation at 27,400. These figures we have already discussed earlier. Now, in order to save that entire amount of tax on long term capital gain, my aim should be that the tax with indexation comes to zero. So, how do I make that amount zero? So, what I will have to do is, in order to arrive at that amount at nil, I will have to invest 1,37,000 in a new asset, or I will have to purchase bonds equivalent to that amount. How did I arrive at that amount of 1,37,000? That is nothing but 5 lakh of selling price reduced by the indexed cost of acquisition is 3,63,000. So the long term capital gain after indexation is 137. So the moment I invest 137, the amount of capital gain after indexation comes to nil, and correspondingly the tax on that will also be nil. So now if I have to compute what is the excess amount that needs to be ignored, the amount will be 50,000. And how that amount will be 50,000? 50,000 is the tax without indexation and the tax with indexation is nil. So the excess amount which I have to ignore is 50,000. So when I am computing the final tax on my long term capital gain, the amount will once again be zero because it is 50,000 of tax with indexation, sorry, 50,000 of tax without indexation, as reduced by the excess amount which I have to ignore of 50,000. So ultimately, I'm arriving at nil. So by virtue of investing 1,37,000, I can now safely say that I have to now not pay any taxes on long-term capital gain. But does this solve the entire problem? The answer is no. Because now let us compute my total income. So the total income is income from salary of 48,50,000, income from long-term capital gain. Now applying that same concept which we discussed earlier, what is the income from long-term capital gain? It will be 5 lakhs of selling price reduced by 4 lakhs, reduced by 1 lakh. So we arrive at 4 lakh of rupees. Now this 4 lakh of rupees has to be further reduced by the exemption what I am claiming. The exemption is nothing but the investment what I have done. So I have invested 1,37,000. So the net amount comes to 2,63,000. Here, just to give you a reminder, the amount will not be zero, because as we just discussed that relaxation, we are applying that relaxation, and that relaxation is applicable only with respect to computation of tax. When I am computing my total income as far as capital gain is concerned, the amount will be 2,63,000. So the total income in this particular case is 1 lakh 51 lakh 13,000. So now if we can understand what is happening, though I am not paying taxes on my long term capital gain, I am now subjected to a surcharge merely because my income is exceeding 50 lakhs. So now I have to pay surcharge on tax on the salary income which I have earned, because tax on long term capital gain is nil because I have invested. But I will have to pay a tax on my salary income. Now that tax on salary income will be now subjected to a surcharge because my total income is exceeding 50 lakh of rupees. Though my salary is below 50 lakhs, below the threshold of surcharge, still I have to pay taxes, or still I have to pay surcharge on that particular tax. So this is a very important thing which we all need to keep in mind whenever we are making investment decisions, as far as the exemption under 54 or 54F and 54EC is concerned. This particular indexation benefit which have been done away with will also have a bearing when you are claiming a rebate under section 87A. So under the income tax act there is a rebate which has been given. Under the new tax regime it says that the income, if the total income does not exceed 7 lakhs, you are given a rebate, and under the old tax regime if your total income does not exceed 5 lakhs, you are once again given a rebate depending upon the type of taxation scheme which you are following. Now, applying the same concept of this indexation which we just discussed, there is high chances or high possibility that the manner in which you compute the total income, you might also lose the rebate under section 87A. So the intention behind this video is to give you a brief background about all these changes which have been brought about and the implications as far as your computation of tax liability as well as investment decision is concerned, for the purpose of saving taxes on capital gain. So for more such insights and detailed updates and discussions on direct taxes, please do subscribe to my channel Income Tax with CA Aditya. Thank you.